Basics of derivatives market. We will discuss following topics. 1. Derivatives basics. 2. Types of derivatives like future, forwards, options, and swaps. 3. Economic function of derivative market. 4. Details of forward contracts like features of forward and forward pricing. 5. Details for future contracts like future standardization and future pricing. What is derivative? A derivative is an instrument whose value is derived from the value of one or more underlying, which can be commodities, precious metals, currency, bonds, stocks, or stocks indices, and many more. The value is influenced by the features of the derivative contract, which may include the timing of the contract fulfillment, the value of the underlying instrument, and other factors such as volatility. Derivatives are widely used to speculate on future price expectations, or to reduce a portfolio risk of underlying asset. For example, commodity derivatives are used by farmers and millers to provide a degree of insurance. The farmer enters the contract to lock in an acceptable price, which is his production cost plus profit for the commodity. And the miller enters the contract to lock in a guaranteed supply of the commodity. Although both the farmer and the miller have reduced risk by hedging, both remain exposed to the risks that prices will change. Types of derivatives. Derivatives are classified mainly in 4 types: forwards, futures, options, and swaps. Derivatives can also be classified as the way an instrument is traded. Exchange traded, for example, futures and options. These are standardized and less risky instruments. Over-the-counter or OTC, for example, forward contracts and swap agreements, these are customized but more risky as counterparties are involved. Types of derivatives contracts. The table shows various types of derivative contracts. Underlying assets like equity, commodity, interest rate, credit and FX have various exchange-traded as well as OTC derivatives. Exchange-traded futures like index and stock futures, commodity futures, interest rate futures linked LIBOR, bond futures and currency futures. Exchange-traded options like stock and index options, commodity options, interest rate options, options on bond futures, and currency options. OTC swaps like equity swaps, commodity swaps, interest rate swaps, IRS, credit default swaps, CDS, and currency swaps. OTC forwards like equity forwards, commodity forwards, forward rate agreements, FRAs, and currency forwards. OTC options like long-term stock options or warrants, commodity OTC options, interest rate caps and floors, collars, swaptions, options on credit default swaps, and currency options. Economic function of derivative market. Prices in an organized derivatives market reflect the perception of the market participants about the future and lead the prices of underlying to the perceived future level. Thus, derivatives help in discovery of future as well as current prices of the underlying assets. The derivatives market helps to transfer risks from those who have them but do not like them to those who have an appetite for them. Derivatives, due to their inherent nature, are linked to the underlying cash markets. With the introduction of derivatives, the underlying market witnesses higher trading volumes. Speculative trades shift to a more controlled environment in derivatives market. An important incidental benefit that flows from derivatives trading is that it acts as a catalyst for new entrepreneurial activity. Forward contracts. A forward contract is an agreement to buy or sell an asset on a specified date and at specified price. One of the parties to the contract assumes a long position and agrees to buy the underlying asset on a certain specified future date for a certain specified price. The other party assumes a short position and agrees to sell the asset on the same date for the same price. Other contract details like Delivery date, price, and quantity or quality are negotiated bilaterally by the parties to the contract. The forward contracts are normally traded over the counter, OTC. Features of forward contracts. They are bilateral contracts and hence exposed to counterparty risk. Each contract is custom designed, and hence is unique in terms of contract size, expiration date, and the asset type and quality. The contract price is generally not available in public domain. On the expiration date, the contract has to be settled by delivery of the asset. Nowadays, most of the forward contracts, rather OTC derivatives, are regulated through various regulatory bodies worldwide. Forward contract example. A garment exporter from India supplies garments to a store based in US. He will receive payment in dollars, but after a credit period of 3 months. In the meantime, due to market volatility, he expects rupee to appreciate against dollar, which is a loss for him. He can enter into a forward contract with a bank to lock in the rate, at which his dollar receipt will be converted into rupees. Through this transaction he transferred the risk of rupee appreciation to the bank. In above example, let's see how profit and loss is calculated. Case 1. If the USD INR rate goes to 70, that is INR appreciated, as per exporter's expectations at the time of forward maturity. In this case he will be in profit, as the USD INR rate he will be getting is 75.35 although market rate is 70. Profit due to forward transaction will be 5.35, that is, 75.35 minus 70, multiplied by contract size. Case 2. If USD Indian rupee exchange rate goes to 80, at the time of forward maturity, that is INR depreciated against the exporter's expectation, the exporter will lose the gain of 4.65, that is 80, minus 75.35, as he has locked in his USD INR forward exchange rate to 75.35. Forward pricing. Forward price is the predetermined delivery price for an underlying commodity, currency, or any other financial asset as decided by the buyer and the seller of the forward contract, to be paid at a predetermined date, in the future. Forward price is the price at which a seller delivers an underlying asset, financial derivative, or currency, to the buyer of a forward contract, at a predetermined date. It is roughly equal to the spot price, plus associated carrying costs such as storage costs, interest cost of holding the asset, and convenience yield etc. Forward pricing formula. Forward price is affected by factors such as current spot price of the underlying asset, time until maturity, carrying costs such as interest cost, storage costs, and other costs like convenience yield or opportunity cost. It's given by the formula F is equals to S multiplied by E raised to R plus Q into T, where F equals forward price, S equals spot price of the underlying, R equals risk-free rate, Q equals carrying cost or convenience yield, T equals time till maturity, and E equals mathematical irrational constant approximately equals to 2.7183. Futures contract. A futures contract is an agreement between two parties to buy or sell an asset at a certain time in the future and at a certain price. But unlike forward contracts, the futures contracts are standardized and exchange traded. To facilitate liquidity in the futures contracts, the exchange specifies certain standard features of the contract. In below example, you can add any underlying asset like equity, or commodity, or credit, with features like expiration date, quantity, or quality. It will become futures contract. The features like underlying asset, quantity, expiration dates, are standardized by exchanges. An oil producer needs to sell their oil. They may use futures contracts to do it. This way they can lock in a price they will sell at, and then deliver the oil to the buyer when the futures contract expires. So oil producer becomes seller in futures contract. Similarly, a manufacturing company may need oil for making widgets. Since they like to plan ahead, and always have oil coming in each month, they too may use futures contracts. This way they know in advance the price they will pay for oil, the futures contract price, and they know they will be taking delivery of the oil once the contract expires. So manufacturing company becomes buyer in the futures contract. Futures standardization. Below are the few features of the futures contract which are standardized. Quantity of the underlying. Quality of the underlying. The date and the month of delivery and settlement type. The units of price quotation and minimum price change. Location of settlement. In below example, shows details of S&P 500 index futures contracts. Where expiration month is September 21st. Contract size is 50. Settlement type is cash. Settlement date is September 27, 2021. Tick size is 0.25. Tick value is 12.5, that is, 0.25 into 50. Distinction between futures and forwards. Futures trades on an organized stock exchanges, whereas forwards trades at over-the-counter. Futures are standardized contracts, whereas forwards are custom designed. Futures are more liquid as traded on exchanges, whereas forwards are less liquid due to OTC in nature. Futures need margin requirements, marking to market, and margin calls are required, whereas forward contracts do not have these requirements. Futures normally follow daily settlements, whereas forwards settle only at the maturity. Participants in futures trading. There are three main categories of futures trading participants: hedgers, speculators, and arbitrageurs. Hedgers. In general, hedgers use futures for protection against adverse future price movements in the underlying assets. For example, suppose investor is holding Reliance Industries stock in 5,000 quantity and wants to safeguard against adverse future price movement. Investor can enter into Reliance Industries futures contract and sell 5 futures contracts having lot size 1,000 in order to hedge the holdings. Let's assume Reliance current market price equals 2,100 Indian rupees, Reliance September 2021 future contract price equals 2,150 Indian rupees, futures lot size equals 1,000. Investor need to take short position in Reliance September 2021 futures contract, 5 numbers in order to hedge his position. Now let's see how future contract nullifies the losses. If Reliance share price moved down by September 2021 to 1,500 Indian rupees, his stock portfolio value comes down by 3 million Indian rupees, that is, 600 into 5,000. But as he has already sold September future contracts at 2,150, his profit from future contracts will be 3,250,000 Indian rupees, that is, 650 into 5,000, thus, it nullifies the losses occurred in portfolio. Speculators. They are the second major group in futures trading. These participants include independent traders and investors. They are in futures market to speculate on assets price and multiply gain due to leveraging of the positions. Arbitrageurs. Futures arbitrage would refer to leveraging the price difference between an underlying asset and the price of the asset's future contract. This difference between cash and future price is known as basis. As the expiration date approaches, both the future and spot prices will become same. For example, Microsoft stock is trading at $270 currently in spot market, and in future market it's trading at $275. An arbitrager can see this as an opportunity and create a buy position in Microsoft in cash at $270 and sell the Microsoft future at $275 in order to get risk-free profit of $5 at the end of futures expiry. Future terminologies. Spot price, the price at which an underlying asset trades in the spot market. Futures price, the price that is agreed upon at the time of the contract for the delivery of an asset at a specific future date. Contract cycle, it is the period over which a contract trades. Monthly and yearly contract cycles are available in most of the exchanges. Expiry date is the date on which the final settlement of the contract takes place. Contract size, the amount of asset that has to be delivered under one contract. This is also called as the lot size. Notional value of the contract, contract notional value, also known as contract value, is the financial expression of the contract unit and the current futures contract price. For example, if WTI crude oil is trading at $75 per barrel, and the contract size is 100 barrels, the notional amount would be $75 into 100 equals to $7,500. Cost of carry measures the storage cost, plus the interest that is paid to finance the asset, less the income earned on the asset. In the derivatives market for futures and forwards, cost of carry is a component in calculation for the futures price. The cost of carry associated with a physical commodity generally involves expenses tied to all of the storage costs an investor forgoes over a period of time. It includes things like cost of physical inventory storage, insurance, and any potential losses from obsolescence. The futures market price calculation also takes into consideration convenience yield, which is a value benefit of actually holding the commodity. Basis is defined as the futures price minus the spot price. There will be a different basis for each delivery month for each contract. In a normal market, basis will be positive. This reflects that futures prices normally exceed spot prices. For example, if Facebook stock is trading at $350 in spot market, and nearest month future is trading at $355, then basis is positive, that is 355 future price minus 350 spot price. Margining system in futures. Futures margin is the amount of money that you must deposit and keep on hand with your broker when you open a futures position. It is not a down payment, and you do not own the underlying asset. Futures margin generally represents a smaller percentage of the notional value of the contract, typically 3 to 25% per futures contract. When markets are changing rapidly, and daily price moves become more volatile, market conditions and the clearinghouse's margin methodology may result in higher margin requirements to account for increased risk. When market conditions and the margin methodology warrant, margin requirements may be reduced. Initial margin, the amount that must be deposited in the margin account at the time of initiation of futures contract. Maintenance margin, it is the minimum amount that must be maintained at any given time in your account. The above diagram shows the graphical representation of margin systems. Initial margin is equals to maintenance margin, plus additional margin, also called as variation margin. If the funds in your account drop below the maintenance margin level, a few things can happen. You may receive a margin call, where you will be required to add more funds immediately to bring the account back up to the initial margin level. If you do not or cannot meet the margin call, you may be able to reduce your position in accordance with the amount of funds remaining in your account. If you are not able to meet margin requirements, your position may be liquidated automatically once it drops below the maintenance margin level. Settlement of futures. Futures contracts have two types of settlements. 1. Cash settlement. The cash settlement method is normally used in settlement of index futures. Cash settlement involves the purchaser or the contract holder to pay the net cash amount on the settlement date and execute the contract settlement. The net cash amount is the difference between the spot price, SP, and the futures price, FP, of the underlyings. 2. Physical settlement. The physical delivery method is normally used of settling commodity futures contract. The physical delivery settlement process is coordinated and settled via a clearing broker or a clearing agent. If the contract holder opts to take a short position, they are responsible for the physical delivery of the underlying asset. If the holder opts to take a long position, they will be taking, that is, receiving physical delivery of the underlying asset. Mark-to-market settlement, MTM settlement, which happens on a continuous basis at the end of each day. Final settlement happens on the last trading day of the futures contract. Futures pricing. Many factors affect the price of futures contract, such as interest rates, storage costs, and convenience yield like dividend income. The futures price of a non-dividend paying and non-storable asset is the function of the risk-free rate, spot price, and time to maturity. Assets that are expected to pay an income will decrease the price of the futures. Storage costs always increase the futures price, as the seller of the futures incorporates the cost into the contract. Convenience yields, which indicate the benefit of owning another asset rather than the futures, decrease the futures price. Futures pricing formula. Futures contract price can be calculated by using below formula. 1. For non-dividend paying and non-storable asset, futures price equals to S into E raised to R multiplied by T, where S equals spot price, R equals risk-free rate, T equals time to maturity, and E equals mathematical irrational constant approximately equals to 2.7183. 2. For dividend-paying and storable assets, futures price can be calculated as F is equals to S multiplied by E raised to R plus Q into T, where F equals futures price, S equals spot price of the underlying, R equals risk-free rate, Q equals carrying cost or convenience yield, T equals time till maturity, and E equals mathematical irrational constant approximately equals to 2.7183.